They tell you the market is ruthless, that when things go wrong, everyone pays the price. No exceptions. That story sounds fair, it sounds clean, and it's almost completely wrong. Because in every major financial crisis, there's an unspoken rule. It's never written down, it's never announced at a press conference, but it quietly decides who survives and who doesn't. And once you see it, you can't unsee it. Here's the uncomfortable truth. During crises, the system does not protect everyone. It protects continuity. And continuity usually looks like big players. Right now, this matters more than ever. Debt is higher than it's ever been. Markets are faster, more interconnected, and more fragile. And the next shock, whatever form it takes, won't be handled the way people expect. So let's slow this down and strip away the myths. Because crises don't break the rules of finance, they reveal them. Think back to 2008. Banks collapsing, markets freezing, people losing homes, jobs, savings. The story most people remember is simple. Banks were reckless. They failed. They got bailed out. But that skips the most important part. Not all banks were saved. Not all investors were protected. Some firms vanished completely. Others walked away bruised but alive. Why? Because the system made a choice. When Lehman Brothers failed, it wasn't the biggest bank. It wasn't the most reckless, but it was allowed to die. Just days later, AIG, an insurance company most people had never heard of, was rescued with over $180 billion. Same crisis, same panic, different outcome. That wasn't hypocrisy, it was logic. Cold, mechanical logic. Here's the rule, the one no one likes to say out loud. In a crisis, institutions aren't judged by how wrong they were. They're judged by how dangerous their failure would be to the system itself. This is where most explanations stop and start blaming morality, greed, corruption, unfairness. Those things exist, but they're not the core mechanism. The real driver is something far more boring and far more powerful: interdependence. Modern finance isn't a collection of independent players, it's a web. Banks lend to banks. Funds insure funds. Pensions rely on markets that rely on liquidity that relies on confidence. By the time a crisis hits, no one is standing alone. So when a big institution starts to fail, decision makers don't ask, who deserves help? They ask, what breaks if this stops? And that question changes everything. Imagine a massive cargo ship losing power in a narrow canal. It's not just the ship that's stuck, it's global trade. You don't fix that by lecturing the captain. You fix it because the blockage itself is the emergency. That's how financial crises are managed. The system isn't saving companies, it's unclogging arteries. This is why the phrase "too big to fail" is misleading. Size alone isn't the issue, it's being too connected to fail. An institution becomes protected when its failure would force others to fail instantly. Not eventually, not hypothetically, immediately. That's the line. And here's where it gets uncomfortable. The system doesn't wait to see if the damage happens. It assumes it will. Because in a panic, speed matters more than precision. So central banks step in. Governments step in. Rules bend. Liquidity appears where none existed before. Assets suddenly become acceptable as collateral. Losses are socialized quietly, while gains were privatized loudly years earlier. Not because policymakers love banks, but because they fear cascades. A cascade is the real enemy. One failure triggers another. That triggers margin calls. That forces selling. Prices fall. Confidence collapses. And suddenly, the crisis isn't about bad loans, it's about survival. This is why bailouts are rarely framed as gifts. They're framed as stabilization, emergency lending, temporary support. Words matter, because the goal isn't fairness, it's stopping motion from reversing. Now, here's the part almost no one talks about. This rule doesn't just operate during crises, it changes behavior before them. Big players know, deep down, that their collapse would be dangerous, and that knowledge affects how they act. Not consciously, not in villain meetings, but structurally. If you believe the system can't let you fail suddenly, you tolerate more risk. You operate closer to the edge. You assume liquidity will exist because historically it always has. Meanwhile, smaller players live in a different reality. They face hard stop losses, margin calls, no rescue lines. Same market, different safety nets. This isn't a conspiracy. It's a feedback loop. Protection changes incentives. Incentives change behavior. Behavior increases fragility, which means every rescue quietly increases the need for the next one. That's the absurd part. The system protects big players to reduce risk, but by doing so, it slowly increases the scale of future crises. You can see this in the numbers. Before 2008, leverage was high. After 2008, regulations tightened, but total debt kept rising. Not just government debt, corporate debt, household debt, shadow banking debt. Risk didn't disappear. It moved. It changed shape. It hid in places that looked safer. By 2020, when markets seized up again, the response was faster, bigger, less hesitant. Trillions created in weeks, markets stabilized almost instantly. From the outside, it looked like mastery. From the inside, it was urgency. Because once you accept the rule, hesitation becomes dangerous. If markets believe support will come, delaying it can make things worse. So policymakers act early, even if the long-term costs are unclear. And those costs matter, because every intervention teaches the system something. It teaches markets that extreme outcomes will be managed, that liquidity is a promise, not a condition, that certain failures are off-limits. Over time, this blurs the line between risk and guarantee. And that brings us to the quiet contradiction at the heart of modern finance. Markets are supposed to price risk, but crises reveal that some risks aren't allowed to fully materialize, which means prices lie just a little during calm periods. Volatility stays low, confidence stays high, leverage builds, until something breaks. Then suddenly, everyone remembers how fragile things actually are. This is why crises always feel shocking, even when the warning signs were obvious. The system trains us to forget its limits. So where does this leave everyone else? The uncomfortable answer is this: the system isn't designed to protect individuals, it's designed to protect function. Jobs, savings, pensions, those are indirect beneficiaries. They're protected only if protecting them aligns with keeping the machine running. Sometimes it does, sometimes it doesn't. That's why the pain of crises feels uneven, why markets recover faster than people, why asset prices bounce while wages lag. It's not malice, it's priority. And once you understand the priority, a lot of confusing things make sense. Why governments argue about bailouts but agree on liquidity. Why central banks act even when politicians hesitate. Why some failures are framed as necessary while others are unthinkable. The unspoken rule isn't about favoritism, it's about containment. But here's the final twist. As the system grows more complex, the number of unthinkable failures grows with it. More connections, more dependencies, more institutions that can't be allowed to stop. Which raises a quiet, dangerous question. If too many players are protected, who's actually bearing the risk? And at what point does stability become an illusion built on constant intervention? Because a system that must always be saved eventually stops being a market. It becomes something else, something dependent, something fragile in a different way. So when the next crisis hits, and it will, the real question won't be who caused it. The real question will be this: how much of the system still needs to be protected before protection itself becomes the risk?